Right, okay. I've got to be fair, for the recording point of view, I've got the volume up as high as it'll go. It's not saving. I'll have to try and find out why that's not happening. But anyway, welcome everyone. Hope everyone's had a good week so far. It's certainly been an interesting one for myself. Guess what we're going to talk about today, folks? Guess what we're going to talk about today? We're going to talk about price action. Some of you may be thinking, oh no, not again, but it's tough. This really is the most important thing you can learn. It is the core of everything I do. Now, I'm just going to briefly go over the price action sequence. When price is making low highs, lower lows, it's going down. When price is making high highs, high lows, it's going up. But where people seem to be getting stuck, and I've had several emails and several questions about this, is that where people are getting stuck on is when it changes from going up to down. So we're going to have a little look at that. And then we're also, rather than think about it from a trading point of view, which we'll also look at today, and we'll take a look at some of the trades using this price action sequence that I talk about so frequently. We're going to take a look at some trades, but also we're going to look at how to actually manage the trades with the same sequence of events. So can we use price action, price activity, the sequence of events that we're going to talk about and going to show you, can we use that same patterns, that same reoccurring sequence of events to manage the trade? So from a money management point of view, we can let the chart's price action activity to show us how to manage the trade based on the volatility of the market at the time. So very briefly then, I'm just going to go over just a few pointers just to remind people of what the price action sequence is, and also some of the newer people just as an introduction. Random point on the chart, 240-minute chart on the pound dollar if you want to follow through for yourselves. And what we're looking at, all we're doing is counting the swing highs. So a swing high is a 3-bar combination. Just zoom in. It's a bar preceded and succeeded by lower bar highs. So the bar before and the bar after the highest point of that bar creates a swing high. Swing low is a bar preceded and succeeded by higher bar lows. So it's a 3-bar combination. So with that in mind, we can start to build a framework of price activity, just counting back a few swing highs and a few swing lows. So what we can see, if we just mark off the swing highs and the swing lows, we can start to build a framework of what is actually happening. These are facts. You can't deny these things. We can build a framework of what is actually happening on the markets. When price is making higher highs, higher lows, it's going up. When price is making lower highs, lower lows, it's going down. When price is making neither new highs or new lows, price is range bound. It's a very, very simple concept, folks. But what is holding people up is the turning points. So I've actually marked off 2 turning points here. Let's just say what we see on the chart. Low, lower high. It's lower than the previous swing high. Higher low, higher high. So for a long, when price is making higher highs, higher lows, it's going up. So let's just scroll back. So in real time, I think in real time, this is where it's confusing people. In real time, what we'd be looking at would be this point of the chart. At this point of the chart, price is making low, lower high, higher low, higher high. So when that swing high is developed, whether it be on a 240-minute chart, a 1-minute chart, a 5-minute chart, whatever time frame you're looking at, and to be fair, on any instrument that you look at, when price makes that swing high, if price goes above that swing high, price will be in an uptrend. Now I can also use the same pattern for an entry. So if I was looking to go long, let's just say this was my entry time frame, and I was looking to buy the markets. And let's just give ourselves a reference. Let's just say price is retraced to a fib retracement. Price is down at the 50 and the 61% retracement. Identify the thrust move. Again, we've talked about this before in the past with fib retracement setups. Price is at the 50% retracement. Let's just say this is my entry time frame. What's it doing there? The first point in time that price is making higher highs, higher lows is at this point of the chart. Low, lower high, higher low, higher high. This is your 1, 2, 3 pattern, and that higher high, that higher swing high creates the entry. That's the pullback. So it's 1, 2, 3 pullback, 1, 2, 3 Ross hook, 1, 2, 3. Some people call this part of 4, 5. 1, 2, 3, 4, 5. This is also trading the first pullback after the failure to make a new low, the reverse for a short. So this is a bias change. It's got many different names, but that's what it looks like. So you would be so again, thinking about an entry as well as just for a direction bias. A new direction bias to the long side will be established through this yellow line here. But if I was looking for an entry and to use this as an entry trigger into a movement, then this is exactly the same entry, an entry above that higher swing high. Now the higher low is still developing. That's still developing. So when that higher swing high develops, that creates the entry, and I'd be looking to go long above that higher swing high. The higher low is still developing, as we know. It takes a while to develop, eventually triggers, and now you would be long on the market. For me, stop losses go past the event. The event is the lowest point of the pattern. So the pattern that I've traded technically is a 1, 2, 3 pullback. 1, 2, 3 reversal with a pullback. I tend to refer to these as a bias change because it's the first point in time that the bias is changing. So is everyone happy with that? This is the bias change. So when that swing high develops, is created, the higher low is still developing, so we don't need to worry about that. It's just when that swing high, that creates the entry. Does everyone understand the concept? Everyone understand that? Any questions so far? This is really the sticking point for most people. Because it's usually quite easy to see when the market is already trending either up or down or range bound. So when that swing high is created, higher swing high. When that's created, that creates the entry. Again, we're on a 240-minute chart. I typically use this time frame for a direction bias. So if price goes above that swing high, then I'm now biased to the long side looking for long trades. But if this was, say, a 1-minute chart, a 5-minute chart, or even a 15-minute chart, whatever your entry time frame is, this is exactly the same pattern. It doesn't matter on the time frame. It's the same pattern. So price is making higher lows. That eventually develops and then triggers the trade. Now, this was obviously very short-lived. So let's now go through a slight variation of the same pattern, but to the short side. So remember, the definition of a trend is when price makes higher highs, higher lows, it's going up. In this case, we know with a little bit of hindsight it was short-lived. But when price is making lower highs, lower lows, it's going down. Now, this is basically the difference between Dow theory and Elliott wave. This is more an Elliott wave pattern, high highs, high lows. Let's take a look at Dow theory. Dow theory says on the breach of a previous swing low, we can basically trade the first pullback. Or breach of a previous swing high, we can trade the first pullback. Price at this point of the chart is now making lower lows. So if price was to go below, let's get rid of that. So if price is now to go below this swing low, so what we're doing is we count the sequence. Count the swing highs. Low, lower high, higher low, higher high, higher low, higher high, lower swing low. So price is making lower lows. By definition, if price was to go below that last swing low, it would make a lower high. So you would have lower lows, lower highs. So again, in real time, that lower high is developing. So if price goes below that swing low that's just created through 170, 100s, this yellow line, price is making lower lows and the lower high will follow. So when price is making lower lows, lower highs, it's going down. When it's making higher highs, higher lows, it's going up. So this is just an alternative variation. Now in this case, you're trading the 1, 2, 3 pattern directly, but you're trading it on the breach of a previous swing low and for a long, the breach of a previous swing high. So two different variations of the same philosophy. When price is making higher lows, higher highs, it's going up. When price is making lower highs, lower lows, it's going down. It's already making the lower lows at this point of the chart. So if price goes below 170, 100s, it's going to go down. The lower high is developing. So at this point of the chart, you're now biased to the short side, and we all know what happens. Obviously, we're looking at this with hindsight. Now, finally, so does everyone understand? At a very basic level, there's two versions of the bias change, and that's them. a more Elliott wave style of a bias change, and basically a Dow version or a Dow theory version of a bias change. So has everyone got those two concepts? So that is when price changes direction. That's the first point in time that it's making either higher highs, higher lows, or lower highs, lower lows, and they're the two different variations of the pattern. And then this has basically been a sticking point. I've had several emails about this and asked to be commented on. There's a video on the blog about this as well. And that is basically the bias change. So if everyone's happy with that, we will move on. So the other part of the sequence is when price is making neither new highs or new lows. So it's making lower highs, lower lows, lower highs, lower lows, lower low, lower high, higher lows, lower highs. So it's making a higher low and a lower high, but it's not a higher high, it's not, and this isn't a lower low, so it's not making a new high or a new low on the move. So what I'm interested in is the extreme boundaries of support and resistance. So that now is my range definition, when price is making neither a new low on the move or a new high. So it's making a higher low and a lower high within the previous swing high and the previous swing low to be made. So price is range bound. If you want to put the label on this, at this point of the chart, you're looking pretty much at an asymmetrical triangle. Again, I don't really care what you call it. I'm not interested in what the pattern's called. I'm interested in the extreme boundaries of support and resistance. So the extreme boundaries of support and resistance is the two yellow lines. Trend lines I find too dynamic. I do appreciate that people use them and use them very successfully. Personally, I don't. I don't like them. So the extreme boundaries of support and resistance, that's my range. So I can trade the breakout pullback of that range in either direction, either for a continuation in price, and price will resume the already established downtrend, or I could also use this as a direction change. If it breaks out to the long side, which we know it did, price will be going up. So I've got a breakout pullback of a range, and now price is making, guess what, higher highs, higher lows. It's going up. It was in a range, but it's broke out. So we can also use those as a direction change. Sorry, this question from Coco. Is that the same as the previous peak takeout? I'm not sure, to be fair, Coco, I'm not sure what you mean. Could you elaborate on the question and we'll come back to it? So, come back to the live part of the chart. Price is making higher highs, higher lows, or lower highs, lower lows. It's either going up, down, or sideways. So that's it. That is really the price action sequence. It's actually a very simple concept, but until you get to grips with it, it's obviously a little bit frustrating while you're trying to learn something new. But that really is what the core, the basis of everything I do. If I'm looking for an Asian range, ideally, I'm looking for the 60 minutes charts to show me price not making new highs or new lows. That's the pattern I'm looking for in the Asian session range. Higher lows and lower highs within the previous swing high and the previous swing low. For the Asian range breakout, that's what I'm looking for. So let's just take a look at some trades. Let's see how to apply this with a strategy, and then we'll look at how to apply this same technique for trade management. So let's go on to the, we're looking at CAD yen. Got CAD yen on the go. So this is my usual setup. What we can see, 4 charts, symbols. So this is my usual setup. So what we can see on the chart is I've got the bias changes already marked up. This is something I'm doing in my own live trading room. So price was very briefly in an uptrend. What can we see? Higher highs, higher lows, higher high, higher low, lower low, and the lower high. So what we've got is from this point of the charts, price is now in a newly established downtrend. The previous uptrend was very short-lived. The newly established downtrend is now again in force. So from this point of the chart, I'm looking for short trading opportunities. So let's think about the strategy as a whole, strategies that are used as things that we've been going through on a day-to-day basis. Things that have been going through on a day-to-day basis. I'm trying to answer, as a part of my trading plan, 3 basic questions. Where's price now? What's it doing? And how can I get involved in the markets? So first of all, I'm going to deal with facts. The facts of the market are price action. When price is making higher highs, higher lows, it's going up. When price is making lower highs, lower lows, it's going down. So from a strategy point of view, I'm now biased to the short side. On the 240-minute chart, I'm looking for a short trading opportunity. Why? Because I'm a trend trader. So I'm looking to sell the rallies in a downtrend. And if we get an Asian session range, which we have got a few today, I'm going to look to sell the breakouts of the lows of those ranges. So the 240-minute chart, where's price now? It's in a downtrend. It is making lower highs, lower lows. That is a fact. You cannot deny that. Price is in a downtrend. Oops, bear with me. So price is now making lower highs, lower lows. It's going down. So what am I looking for? I'm looking to sell the rallies in a downtrend. So the first thing for me would be to look for a rally in a downtrend. A reference that I use, a tool that I use to identify a location would be fibs. Coco, I'll come on to that in a moment. Yeah, that's important. I'm going to take fibs from, first of all, yesterday's high down to today's lows. I'm looking, again, keep in mind that my objective is to capture the main move of the day. So I'm going to look for the main turning points to apply my fib tool. This is again that we've been through in a previous webinar. For my application of fibs, I like to use current day's highs, current day's lows, previous day's highs, previous day's lows. So I'm always going to use those same reference points. So yesterday's high, today's low. This is something we went through in real time in my trading room. So when price gets up to the 50 or the 61% retracement, I'm going to look to sell the rallies in a downtrend. We're in a downtrend on the 240-minute chart. I've now got a reference, a location that I'm prepared to get involved in the market, which is the 50 or the 61% retracement. Price this morning was at the 61% retracement. I'm looking to sell the rallies in a downtrend. So now I'm asking on the lower time frames, for me that's the 89-tick chart, where's price now? What's it doing? The same two questions. I'm looking for facts. Where's price now? What's it doing? How can I get involved? Price is in a downtrend on the 240. It's clearly in a downtrend on the 60 and 15-minute chart, slightly range bound. I'm looking to sell the rallies in a downtrend. Fibs from previous day's highs to current day's lows. Price is up at the 61% retracement. I'm looking to, I've identified a location on the chart that I'm prepared to take a trade on relative to the tools and the strategies that I use. So what's going on there? What happened at the 81.60 level? Price over at this point of the chart. Yeah, let's just scroll back in time slightly. So what was going on? Does that look familiar on the 89-tick chart? If you don't have an 89-tick chart, a 2 or a 3-minute chart will do just as well. But what can you see? Say what you see. What do you see, folks? What can you identify at the 61% retracement on the lower time frames? 1, 2, 3 pattern. Yeah, 1, 2, 3 pullback, 1, 2, 3 Ross hook, whatever you want to call it. Lower highs, lower lows, bias change. Everyone's got different names for it. There's no right or wrong. This is why I don't really care what you call it. You can call it a pink elephant. You've got a nice pink elephant pattern set up. It doesn't matter what you call it, as long as you understand what's going on. Saeed, yeah, it's going down. It's the first point in time that price is making lower highs, lower lows. But guess what? It's at a place, a level of interest that I want to take a trade on. I'm going to sell the rallies in a downtrend. How am I going to identify those locations? Well, I like to use fibs. So 50 or 61%, it got to the 61% this morning. What was price doing? High, higher low, lower high, lower low. When price goes below that lower swing low, that's where my entry is going to be below 81.49. It's the same pattern. High, higher low, lower high, lower low. Stop loss goes past the events that cause me to get in the trade. So I'm going to have an entry below 81.49 with a stop loss above 81.79. It's a bias change pattern. The first point in time at a location on the chart that I'm interested in. Does that make sense, folks? Everyone happy with that? Yeah. So now what? Now what do we do? Well, we're going to try and manage the trade. So this is the routine based on, everything's based on price action. So what next? What happened next? What I'm looking to do now, from a trade management point of view, is remove the risk off the trade. I've got a trade on. I'm short on this CAD yen from 81.45 with a stop loss at 81.90. That was how I've managed my trades. So I've got a 45-point stop loss size. Now, what I like to, again, things we've talked about in the past, these are on my website. These are things that we've already covered. I want to remove the risk off the trade. I want to sleep at night. If it doesn't work out, I want to try and minimize the damage. So I'm going to take 2/3 of my position off at 50% of the stop loss size. So if I've got a stop loss size of 45 points, half of 45 is 22.5. Personally, I like to round up and down, so I'll call that 25. So I'm looking to scale out 2/3 of my position at plus 25. So plus 25 takes me down to 81.20. So I'm now waiting to see if price is going to get there. Price eventually gets there, 81.20. At this point of the chart, I've scaled out 2/3 of the position for plus 25. The last third of the position, its stop loss stays at 81.90. I do not move my stop losses without reason. So I've got 2 times 25 on 2/3 of the position. So 2 times 25 is 50. The last third of the position has still got a risk of 45 points. So if that now gets stopped out, it's cost me nothing other than time. It's actually a slightly profitable trade. That's how I manage the trade to a break-even point. I don't physically move my stop losses. So the risk at this stage of the chart is now being removed from the trade. It's not going to cost me anything other than time invested. Everyone happy with the trade management? Excellent. Right, okay. So what am I looking for now? Now, bear in mind once again that my objective is to capture the main move of the day. So again, assuming that this is going to be the high of the day, I'm selling the rallies in a downtrend. I wanted to give the trade the most amount of opportunity to put in an average day's move. But what if it doesn't get to an average day's move? So the rule I have is when 65% of an average day's move is being done, I'm going to start to actively manage my trade. So this tool that I'm just bringing onto the chart now, on the 60-minute chart, this is just a customized fib retracement tool. The distance between the 2 green lines is an average day's move. So coming back to Coco's question, an average day's move for me is based on a daily 100 period average true range indicator. Do I need the daily chart? Well, to be fair, on the platform that I use, the daily average true range there, this ATR2, I can put it in table format, so I can see that the CAD yen puts in about 220 points. Yeah, you with that? Did you get that, Coco? So personally, I don't need to put the daily chart on. If you don't have the option to look at that in a table format, so let's just adjust that. It needs to be adjusted. So I need 220 points distance. So let's just call it 80 and 82.20. Right, so the distance between those 2 green lines is now the distance of an average day's move. Well, to be fair, David, I don't need to move this. The question was, can you go through why you don't move the stop loss after you've sold off 2/3? To be fair, I don't move my stop losses. Given my own experience from trading, when I was trying to find out what was working best for me, one of the things that always used to happen for me was that whenever I moved my stop loss, because when I first started out, I wasn't scaling out, but when I moved my stop loss, if it say went 30 points in my favor, stop loss to break even. It's a no-brainer. It would then stop me out for +2 and then carry on and do 100 points. So then I'd say, all right, when it goes 50 points in my favor, I'll move the stop loss to break even. So it moves 50 points in my favor, move the stop loss to break even, stops me out for +2, and then goes 100 points without me. But the original trade decision was correct. It was fine. There was nothing wrong with it. So what I noticed that was whenever I moved my stop loss, I would get stopped out. Frustrating, damn frustrating. So what I started looking at doing was I had the trade choice correct, but the trade management for me was incorrect. From Coco, how much of an average daily range has to be made in order to consider a fib? Two ways of looking at it. When price is trending, use a fib. If price is ranging, don't use a fib. When price has done an average day's move, I'm only looking for a fib setup. So price, as we'll see in a moment, has done an average day's move. So for a new trade, I'm only looking for a fib setup. So we'll come on to that in a moment, what I'll be looking for next. So this is a customized tool. The distance into green lines is an average day's move. The top green line I'm going to place on the high of the day. This bottom of the middle two lines, that's going to show me 65% of an average day's move. So when 65% of an average day's move has been done, I'm going to start to actively manage the trade. Let's just catch up to the real part of the chart. So when 65% of an average day's move has been done, so the trigger level for me to next take action is on 65% of an average day's move. This is something I've tested, something that works for me. You could use 50, you could use 40, you could use 80% of an average day's move if you wanted. I find that 65% works fine for me. So when price gets down to the 80-40 level, to be fair, I actually use 80-45 in my room. I had it slightly incorrectly calculated, but split hairs over a few points if we're going to be honest. But when it gets down to the 80-40 level, I'm going to actively manage the trade. So let's see where 80-40 is. 80-40 is there. So when 65% of an average day's move has been done, I can actively manage the trade. It gets down to that level. So what I'm looking for is, guess what? I'm going to count the swing highs. I'm going to use price action and price activity to actively manage the trade. I'm going to trail my intraday stop loss behind the second previous swing high. So as price went through that 80-40 level, lower low, lower high. That lower high, where the cursor is, will be confirmed when price makes a new low on the move. Now I'm looking for the second previous swing low high combination. So the second previous swing low high combination is there. Lower low, lower high. So the second previous swing high is where this blue line is. So for trade management, price action, I can use price action to actively manage the trade. So I'm locking profit in now on the intraday portion trade. I'm short from the red line. My stop loss for the intraday trade is at the blue line, the second previous swing high. So what am I looking for next? I'm looking for swing low, and I'm looking for a new low on the move. So the highest point of the highest point of the retracement after that last swing low was made, that will be confirmed when price makes a new low on the move. Any subsequent lower highs can also be taken into consideration. So let's just count the swing highs. I've got several swing highs to take into account. I've got 1, 2, 3. So the highest point of the retracement will be confirmed as price makes a new low on the move. A new low on the move has been made. The second previous swing high, we've got 4 swing highs that are now can be taken into consideration for active trade management. We can all count to 2. Let's count backwards. 1, 2. So the second previous swing high is that blue arrow there. Sorry, that red arrow. Does everyone understand the trade management? I'm going to trail my intraday stop loss behind the second previous swing high. Does that make sense? Questions? So what am I looking for next? I'm looking for the swing low. Let's catch up to the live part of the chart. Looking for the swing low. The lowest point of the movement is there. The highest point of the retracement will be confirmed as price makes a new low on the move. Now in this case, you will have been stopped out of your intraday portion of the trade. And you've secured a profit. How much profit? that much profit on the intraday portion of the trade. Now, to be fair, let's take a look. I hate Billy bullshitters, excuse my language. I've not managed my current intraday portion, so I'm actually still in this personally because I'm doing this presentation. I'll sort that out later. But here's the trades. CAD yen, short from 81.45. Stop loss originally was 81.90. This is actually a swing portion trade. Typically, I'll move my swing portion with the intention of holding overnight to the entry level. That doesn't get moved until tomorrow. The second previous swing high was what we worked out originally, which is where it was prior to starting this session. Put a new low on the move. I'll sort out my trade management shortly. Let's take a look at the other trades. Exactly the same patterns, folks. Let's see what was going on. See how we can manage the trades. Price is in a downtrend. All we're doing, 3 basic questions. Where's price now? What's it doing? How can I get involved? Price is in a downtrend on the pound yen. Looking to sell the rallies in a downtrend. Price came up to the 50% fib retracement, fibs from yesterday's high down to today's lows. Looking at that location as a place to sell. What happens? Scroll back in time. What was going on? High, higher low, higher high, lower swing low. So on the breach of a previous swing low, I can trade the first pullback. I'm going to go short at that red line there. Trades marked on the screen. Stop loss goes behind the second previous swing high. Now, to be fair, while I've been doing this recording and getting myself ready for it, we've had a few more lower highs, lower lows. So let's just work out where they are to update where the active trade management would be for the trade. So the last swing low was there. Swing low, swing high. That swing high that I've just marked off, that will be confirmed when price makes a new low on the move. The second previous swing high is now there. So your intraday stop loss can come down to above 148.70. New low on the move. Lower low. The lower high will be confirmed. And to be fair in this case, let's just put the other arrow back on. To be fair in this case, it's actually higher than the previous swing high. So although a new low on the move is made, the second previous swing high is still in the same location. So for trade management, that stays where it is. I'm looking for another lower low, lower high combination for trade management. I'm trailing my intraday stop losses behind the second previous swing high. You can quite clearly see, I'm sure, there's the trades we talked about. These are the patterns that we've talked about. This was the same trade that we took on the pound yen. It's the same trades. Let's take a look at Aussie dollar yen. One last one. Slightly different variation. It's just been stopped out. So, price was making, guess what, folks? Lower highs, lower lows on the 240-minute chart. Where's price now? What's it doing? How can I get involved? Price is making lower highs, lower lows. It's going down. I'm looking for shorts. I'm looking to sell the rallies in a downtrend. Price retraced up to the 61% fib. Fib's taken from yesterday's high to yesterday's low. It was at a location I wanted to take a trade on board. What was going on there? High, high, low, lower, high, high, low, higher high, lower low. On the breach of a previous swing low, I can trade the first pullback. Scaled out pretty quickly there, as you can see. And the stop loss, trade management, put my stop loss above 64.31. I was looking for a new low on the move. There's the last low. It didn't do that, so the stop loss stays where it is. I've now been stopped out on the Aussie dollar Japanese yen for a profit. How much profits? That much profits on the intraday portion. You can see that I've got a swing trade still open. I've got one lot there. The swing trade, I usually tag a swing trade on this with the intention, onto each trade with the intention of holding overnight. And that swing portion of the trade goes to the entry level. There's nothing for me to do until tomorrow with that position. I've already got a previous swing trade on this as well. So I'm building building a position into a downtrend. Sell the rallies in a downtrend. I'm looking to try and build a position. So what am I looking for next? What is next on the agenda? Let's go back to, just scroll back in time. So if I'm looking to sell the rallies in a downtrend, 65% of an average day's move is being done. There's no breakout potential. There's no overnight or Asian session ranges for me to trade. What am I looking for today? From this point onwards, what am I looking for? Well, price is trending. It's making lower highs, lower lows on the 15-minute chart. Fibs from the high of the day this time to the low of the day. Guess what? I've got a 50% retrace. So although I've been stopped out of that intraday portion of the trade, I'm looking for a new short trade at this location. Fibs from the high of the day down to the low of the day. Price is retraced up to the 50%. Can you see the theme, folks? Can you see the theme? Price is retraced up to the 50% fib retracement. What am I going to look for? Guess what? I'm going to look for a bias change on the lower time frames. What's price doing on the lower time frames? Say what you see in the chart. It's making higher lows, higher highs. When price starts making lower highs, lower lows, it'll be going down. So it's still making higher highs, higher lows. I'm looking for a lower high, lower low sequence. I'm now visualizing. So what we've done previously is where's price now, what's it doing? How can I get involved in the market is more of a visualization exercise. You're trying to anticipate what's going to happen next. And relative to the trading plan that we use, based on price action, I know what I'm expecting to happen next. Now, if that was to happen, I can take action. So what am I looking for? Price is at an interesting level for me. Fibs from the higher day down to the lower day. I'm selling the rallies in a downtrend. What am I waiting for to happen? I'm waiting for lower high, lower low. When that lower swing low develops, that's going to create the entry for me. That's it, folks. That's price action. That's price action used to identify the trend, identify trading opportunities, and to manage the trade. Do we have any questions? We've got a few moments to take some questions. But that is it. Everything I do revolves around price action. It revolves around the dynamics of what the market is telling you is going on. Michael, do I consider fundamentals when I trade? No. Personally, I'm of the view that although I am what most people class as a technical trader, because I look at charts, a slightly alternative view is that regardless of how we trade, we are all fundamental traders. We are trading the direction that the fundamentals dictate. I interpret the fundamentals on a short-term basis with technical analysis. Do I read the reports? No. Am I concerned about what is the outcome of those reports? No. Because when price is in a downtrend, it's going down, making lower highs, lower lows, and the fundamentals will reflect that. When prices make it in an uptrend, it will be making higher highs, higher lows, and the fundamentals will reflect that. What do I do when price is in an uptrend? I buy the dips in an uptrend. I sell the rallies in a downtrend. Do I need to focus on fundamentals? For me, I'm not interested in them. Jack, to be fair, we've just been through all this. Which time frames chart do you use to make the direction and make an entry? Hourly, 5 minute? I've just been through exactly what I've done this morning. 240-minute chart, trend direction. My lowest entry time frame is an 89-tick chart. I look for an Asian session range on a 60-minute chart. There's not been too many of those today. There's been one or two. Pound against the dollar. Pound against the dollar. We've got a nice little range. Overnight trading range. Price making high lows, lower highs within the previous swing high and the previous swing low. 60-minute chart, I'll typically look for a range. If it's making high lows and lower highs in the Asian session, I'm looking for fibs off the 15-minute chart. I don't like having clutter, but the direction is based off the 240. I look for an Asian session range on the 60. If it's not there, pretty much step aside from that. 15-minute chart, I usually apply my fibs on that chart. And my entry time frame, my first entry time frame is the 89-tick chart. If the pattern sets up on the 15-minute chart, I'll take it off the 15-minute chart. If it sets up on the 60, I'll take it off the 60. Whichever comes first. But my lowest entry time frame is the 89-tick chart. That's about the equivalent of a 2 or a 3-minute chart. The two entry time frames that I tend to do most of my trades on or the 89-tick chart and the 15-minute chart. All I'm doing is answering 3 questions. Where's price now? What's it doing? How can I get involved? Everything is based around price action. Buy the dips in an uptrend, sell the rallies in a downtrend. When price is range bound, typically I step aside. Any more questions, folks? Any more questions? Any requests to look at a different chart? What you guys want to do? We've got 3-4 minutes before the end of the session. Any questions, comments, observations, any requests? Okay, I'll take that into consideration on the next presentation. Syed, euro dollar. Euro dollar is actually, I'll look at that on the daily charts. It'll make more sense. Let's take a look at the dailies. Don't often look at the dailies, but I have done recently. So I want euro dollar daily. Say what you see in the charts. Price is making higher lows and lower highs within the previous swing high and the previous swing low. It's range bounds. So for me, it's a step aside situation. For me to be interested in trading the euro at the moment, price needs to be at support lows or resistance highs. Right, so support lows and resistance highs is marked up with the daily charts. Again, I don't often stray beyond the 240-minute chart, but price on the 240 it was making high highs, lower lows, high highs, lower lows. You know, it wasn't really, it was pretty directionless. So price making high lows and lower highs within the previous swing high and the previous swing low. Price is range bound. If you want to put the label on this, folks, it's an asymmetrical triangle. I don't really care that you call it an asymmetrical triangle, personally, but if you want to label it, it's an asymmetrical triangle. Technically, it's already broken, but price for me needs to go beyond the extreme boundaries of support, which ties in nicely with the next question. I'm personally interested in the extreme boundaries of support and resistance. So, am I concerned with stop hunting? No, because if I'm looking at the extreme boundaries of support and resistance, and I'm looking at a genuine turning point, and my stop loss is past the events that caused me to get in the trade, it's not based on 30 points, 50 points, 60, it goes past the event. I let the chart tell me how big my stop loss should be. So am I concerned with stop hunting? No, because my stop loss is at a sensible place. Yeah, I'll be taking a slightly wider stop loss than most people would normally do, but hey, if we all did what people normally do, we'd all lose money. So do I want to do what everyone else does? No. My stops go past the events that cause me to get in the trade. If that means I take a 20-point stop loss, it's 20 points. If it means a 60 points, 70, 80-point stop loss size, it's an 80-point stop loss size. The chart will tell me exactly how big my stop should be, and it will be past the main turning points of that move. Range. How far do you look back to determine whether it's range bound? To be fair, you need a high low and a lower high within the previous swing high and the previous swing low. It's on the chart. If it's not doing that, it's making lower highs, lower lows, or high highs, high lows. So in this case, on that point of the chart there, price was range bound and confirmed as range bound. And what I'm interested in is extreme boundaries, support and resistance. Price will become interesting for me when price is at support lows or resistance highs. And one question, Steve: do you base what do you base on for swing trading? So I'm not sure what you mean. What you base on for swing trading? What patterns? What time frames? Patterns are exactly the same. The time frames, usually I'm looking at the 240-minute chart to assess for a swing trade. Usually I'll tag, as I said, usually I'll price in a downtrend on the 240-minute chart, for example on the pound dollar. So normally I'll look to tag a swing trade on to the intraday trade. So I'll get in on an intraday movement and manage it on a day-by-day basis. All right, folks, I think that's it. Just remember, 3 basic questions. Where's price now? What's it doing? How can I get involved? Is price going up, down, or sideways? And you can use price action to determine which phase, on whatever time frame you're looking at, on any markets, any instruments, any time frame that you want. This will work on anything. I started off trading index futures and I used exactly the same patterns. Thank you very much, folks. If you've got any questions, comments, please feel free to send me an email, contact me through the blog, and I'll try and address those questions for you. Very quickly, some fibs setting up. Fibs from the high day down to lower day, looking for a 50% retrace, and I'll be looking for a bias change at that level. Thank you very much. Again, you can follow my blog, and if you need me, just feel free to contact me through that. And have a great trading week, folks. Thank you very much to FX Streets, and I will see you all next week.